Welcome to this series of pre-scene analysis videos on the operational case study for November 2019. So CIMA's pre-scene document for November 2019 for the OCS is based on a fictional company by the name of Chokolate Box. For those of you with a sweet tooth, and I definitely count myself as someone with a very sweet tooth, this case makes for interesting reading indeed. So over the course of the next 10 or so videos, I'll be going through each section of the pre-scene document, highlighting the most important points as they relate to the operational case study exam, highlighting potential exam scenarios, relating the information to theories from E1, F1 and P1, and talking about points of interest to help you make more sense of this information. So without further ado, let's take a look at the opening section of the pre-scene. You're told in the first page of the document that you are a finance officer for Chokolate Box. Your main role is to support Paul Mayer. Paul Mayer is the finance manager, so it's quite likely that you would have plenty of interaction with Paul on the day of the exam. So it's likely that you'll receive triggers in the form of emails from Paul asking you for information and support in interpreting data for variance analysis or looking at financial statement figures for suppliers or competitors, etc. Your tasks include preparation of the annual budget, production of monthly management accounts, providing information to management as required, and also assisting with the preparation of financial statements and queries relating to financial reporting and taxation. So you have a wide scope for potential questions on the day of the exam. In other words, you can expect anything to come up on exam day. It's not just that you will be interacting with finance colleagues. You may well be getting queries from HR, marketing, operational areas of the business. This opening section leaves it quite open-ended. What you can be certain of is that you will be expected to assist the decision makers at the company. You yourself, as a lowly finance officer, won't really be taking any of the big strategic decisions that impact the company over the long term. Instead, you will be providing assistance to the people who do make those decisions. Technical skills make up a big part of what goes into the operational case study exam. As you move up through the levels to management and strategic level at CIMA, technical skills account for less and less of the marks, but at the operational case study, technical skills account for 64% of total marks. What a lot of people worry about is whether they're going to be asked to do detailed calculations on the day of the OCS exam. No, you will not be asked to do detailed calculations. Rather, what's likely to happen is that you would be presented with a table of budget figures or variance figures, and you'd be expected to make sense of them. You'd be expected to comment on any inconsistencies or incorrect assumptions being made on the part of the person sending you an email. Could be someone from a HR area who has misinterpreted some finance figures, for example, and you'd be expected to set them right. The finance officer has a short-term time focus. As you move up through the levels with CIMA, you'll have a longer time horizon. By the time you get to the strategic case study, you will be yourself taking decisions with a long-term impact. You'd be putting in place long-term financing. You'd be making decisions in relation to the product launches, etc., that the company might be opting for, which is a long-term impact on the business. But really, with the operational case study, It's all about the execution of day-to-day tasks and assisting people, managers, etc., to execute those tasks well on a day-to-day basis. So your time horizon isn't really going to go beyond maybe a year. Costing is going to be important. We'll talk about budgets as well. There is budgeting information later on in this pre-seen document. It's quite typical that on the day of the exam, you might be presented with variance questions. You'd be asked to comment on price variances, sales quantity and sales mix variances, for example. So do make sure to revise those areas from your P1 studies. Working capital management will be an important consideration in this exam, as will cash management, and you'll be expected to advise on managing and mitigating risks in the short term. Do make sure that any advice you give as a CIMA trainee accountant is ethical. You should refer to the CIMA Code of Ethics when you're giving advice. If you're presented with an ethically questionable practice by a manager, for example, someone who wants to maybe present figures in an overly optimistic light, you'd be expected to not just give advice that is technically sound, but also that is ethically sound. And examiners love to see the CIMA Code of Ethics referred to in such scenarios, so do refer to it explicitly. You'll have come across the Code of Ethics in your E1 studies. Remember, there are 5 principles and you don't want to violate any of the 5 principles. You want to make sure that any advice you're giving is objective, that you demonstrate professional competence, that you hold confidential information and don't go blurting anything out, that you're professional in your behavior and you demonstrate integrity at all times. So we've taken a look at your role as a finance officer in the business. Now let's take a look in detail at what the business actually does and some of the products that it sells. So we're told the Chokolate Box is a leading premium chocolatier, manufacturing innovative and accessibly priced luxury chocolate. They're based in Estland, which is a fictional country in continental Europe, and they operate with their own currency, the e-dollar. Moreover, the company is a publicly listed enterprise. It's listed on the Estland Stock Exchange. The company was founded in the 1990s by 2 people who are still key to the business, Sebastian Becker, who is the current managing director, and Adam Thoreau, the non-executive chairman. Originally, the company sold chocolates online, but then in 2004, it opened its first physical store, and since then, it has been rapidly expanding with the opening of more stores. It now operates, in 2018, 104 stores. Furthermore, we're told in this opening section that the company's extremely vertically integrated, so it controls many of the steps of its supply chain. It owns, for example, its own cocoa plantation in Teeland, West Africa, and that has great importance to how the company operates. We'll talk more about that plantation in later pages. Okay, so lots of information packed in to these opening sections of the company background. Let's talk a little bit about the fact, first of all, that this is an extremely vertically integrated business. As I say, this is a company that controls many of the steps throughout the value chain. So it would own the suppliers supplying the cocoa, coming from the plantation there, for example. It has presence in stores, so it has control over the retail part of the value chain. And of course, it has control over the manufacturing part of the value chain. So the pros with such a vertically integrated business would be that they exhibit more control over their operations. They control the quality of the supplies coming into the business. They obviously control the manufacturing. They control how the chocolate is being sold and marketed in their own stores. They can coordinate activities better because they control each of the steps in the value chain. They can also take advantage of economies of scale by, for example, consolidating management. They don't have to duplicate tasks with the same finance people operating in the suppliers, and also that task getting duplicated in the manufacturing stage and later at the retail stage. They could rather consolidate that team and have just one central finance team, for example, and that allows them then to lower overall costs. There are, though, cons with being very vertically integrated. The first and most obvious one is that this is going to be a more capital-intensive business. Having to set up manufacturing operations, having to set up and open stores, having to run their plantation means that they're going to have to invest in lots of non-current assets. There's less flexibility being a vertically integrated business. A company that's just manufacturing chocolates, for example, can chop and change between its cocoa suppliers. That's not the case for this business. They're stuck with their cocoa plantation in Teeland. And there's the danger that a vertically integrated company will become less focused as they're trying to do many things well, whereas a manufacturer of chocolate that is just focused on that can become excellent in that area and not have to worry about non-core activities. The fact that the company does have its own plantation, though, I think is a positive, and we'll talk more about that later on, but it gives them a good opportunity to make premium single origin chocolate, which is becoming very well seen nowadays by people who seek out more artisan chocolate makers. They're looking for more premium chocolates, and the company can make more of a claim that they have control over the supply of cocoa, and that is a key ingredient. The customer really nowadays wants more than just a piece of chocolate. They expect the maker to share a story, and it's more easy for Chocolate Box to sell that story given the fact that they control where their key ingredients are coming from. The fact that Chocolate Box is publicly listed comes with a number of benefits and drawbacks. The pros of being a listed company mean obviously that there are more financing options. They're not just relying on debt to finance their operations. Rather, they can tap into equity funding through the sale of shares. Companies that are listed on a stock exchange also tend to have an enhanced reputation. They are seen by the financial analysts, etc. at banks. They're talked about in the financial press. However, there are more onerous regulations for stock exchange listed companies. They have to publish their financial statements on a quarterly basis. They have to have them audited. There is pressure from shareholders for returns, etc. This company is based in the fictional country of Estland, based in continental Europe. That doesn't really narrow it down too much. There are very few hints throughout this pre-scene as to the socioeconomic status of the country. However, we could probably say it's pretty well developed. There is talk throughout the pre-scene of customers in this country moving away from high-fat products, moving to organic and fair trade products. That indicates that they have a degree of spending power that would be typical of a more developed economy. As a publicly listed company as well, the aim for the business is likely to be maximizing shareholder wealth. So any investment decisions that the company is taking needs to keep that primary aim to the fore of its thoughts, and you would do well to do so when giving advice on the day of the exam. So the company is selling chocolate. We'll talk about the different product categories soon, but it's clear that they're very reliant on just one product category. We might ask the question at this early stage whether they might want to look at selling cocoa powder, for example, as a secondary area of business that could be considered a separate product line they might want to sell to other businesses, for example. The fact that they're present in Africa and have a cocoa plantation there raises early questions about the ethical treatment of suppliers. What are labor conditions like in the plantation, for example? Is there a danger that child labor could be employed? That would obviously be ethically terrible for the company to be engaged in something like that, and could be potentially very negatively viewed by the press and consumers in Estland. Moving on then, we see that the company has gained a reputation throughout the years as a business that produces very high quality products, and it has tapped into the general move towards premium products in the consumption of chocolate. That's resulted in rapid growth for the business over the years, and the financial figures of the business reflect that solid growth. In 2018, the company has had 139.6 million of revenues. That is a 10.5% increase versus 2017. And the profit before tax figure at the end of 2018 was $15.3 million, which represented a 13.4% increase versus 2017. That indicates that the company probably has good operating leverage, perhaps is exhibiting solid cost control. The fact that their profits are running ahead of revenue growth means that they have tight control over their other costs. And the fact that their sales stand at just under 140 million for the year of 2018, when we compare that to the wider Estland market, which we'll talk about later on, indicates that they have 2.2% of the total chocolate market in Estland, which to me indicates that there is plenty more ground to be gained in their home market. I think this is a business that is more fixated on product development as opposed to market development. We'll talk about that later on. It's clear that the company is operating with a differentiation strategy. If you think of your E1 studies, Porter's generic strategies, they're focused on a high quality offer. I think it's interesting that they talked about the fact in the opening section of this page that the company had affordably priced or accessibly priced luxury chocolate. I think that's interesting because if they have a high quality offer and a great reputation with high quality, you probably have higher costs of production associated. So if you want to make a profit, you also need the ability to price the products in a premium way. However, if they're pricing them at a more accessible level, they might be depressing their profit margins, and it's maybe something the company wants to consider, increasing their prices slightly. They're operating with the E-dollar. We would ask here whether they're exporting. It's clear in later stages of the pre-scene that they're not, that they're just focused on the Estland market. However, they're likely to have imports in the form of milk powder, the different flavors they use in their chocolate, the fillings they use, and that would mean they're exposed to fluctuations in exchange rates between the E-dollar, the US dollar, euros, etc., wherever they're importing their goods from. The people working at the business, there are 1,248 staff. 242 of those work in production, with 720 in retail operations. And the remainder, in other words, 286 employees, are scattered across different administrative functions such as sales and marketing, finance, HR, IT, etc. So the business has 19% of their staff working in production, 58% in retail operations, so that is the bulk of their staff working in their stores, and 23% in those other administrative areas. The directors at the company, we're told, are relatively young, they're highly enthusiastic, and they're fixated on profitable business development. So remember, when you make recommendations, you need to keep that to the fore of your thoughts. Any recommendations should see the company move towards higher profits when they're talking about development opportunities. The fact that the directors of the company are quite young, they're highly enthusiastic, maybe means that they're more likely to take risks, or they're probably risk neutral. They're not likely to be too conservative. There's always the danger then that they will try to bite off more than they can chew, and they will overextend themselves, perhaps taking on too much debt, or making an imprudent move into a new market or a product category where they cannot win. So we'll talk more about the different directors in the next page. We see here that they have 2 non-executive directors, which satisfies the requirement of a minimum of 2 non-executive directors for smaller businesses. We'd ask at this early stage whether, in accordance with your E1 studies, the company adheres to the codes outlined in the UK Corporate Governance Code, or the Sarbanes-Oxley Act of 2002. And we have discussion here of the corporate governance of the company. They have an audit committee, for example, as well as a remuneration committee and a nomination committee. So those are all areas that indicate the company is adhering to good corporate governance practices. So it's good to see. The audit committee plays a key role in reviewing the accountancy policies and reports of the business, and ensuring that they have internal control and risk management systems in place. The internal audit department is managed by the finance director and reports directly to the audit committee. So it looks that they are taking corporate governance seriously. Again, reflecting on your E1 studies, the hallmarks of good corporate governance, ensuring that there are sufficient checks and balances in place. We can see there the audit committee has a key role to play there. Ensuring that there is good independent scrutiny. You might watch out for potential ethical dilemmas coming up on the day of the exam, and you, as a future CIMA member, could refer such ethical dilemmas to the audit committee. You have an outlet there if something ethically questionable comes up. And ensuring that the company has sufficient outside experience. We see that they have 2 non-executive directors. They might want to extend the number of non-executive directors to ensure good oversight of the executive team's activities. On the next page, we have an extract from the Chokolate Box's organization chart. We can see that they have a functional business structure where similar activities are grouped together and a degree of specialization takes place. This kind of structure is suitable for smaller organizations, centralized organizations in quite stable environment with fewer product offerings. And I think this company ticks a number of those boxes. Like any other organizational structure, there are pros and cons that come with this. The pros would relate to the degree of specialization that can take place, with all of the finance colleagues working in their own silo, pulling together, concentrated on finance activities, all the marketing colleagues working together and doing the same, so they can quickly develop best practices. They can get their heads down and focus on their one area. So a degree of standardization and efficiency comes with this kind of specialization. The cons, though, would relate to teams working in silos. As I said, the finance colleagues would be very fixated on their activities, maybe to the exclusion of other teams, and lacking that ability to get their heads up and consider the wider impact of their activities on the entire business. This kind of functional structure can lead to silos developing, can lead to a longer and slower chain of command, can also lead to competition between different areas for resources, for people, etc. So, as I said, There are pros and cons that come with any type of structure, but overall I think a functional structure is quite suitable for a business that is not huge, and it's a relatively stable environment. As I said, there are not many product offerings. Chocolate is the main focus for this business. They have 3 product ranges, which we'll talk about in a while. There's no mention in this pre-scene of a vision, a mission, the goals and objectives of the business. They talk a little bit about their strategy, which we'll talk about soon. But as I said, that bit is missing: the vision, mission, goals and objectives of the company. So we see here the 2 key people at the business: Sebastian Becker, one of the founders, still has a big shareholding, and Adam Thoreau, who's the non-executive chairman. Josephine Jerome is the sales and marketing director. We'll talk about the importance of the brand perception. She will have a key role to play there. Also the fact that there are 720 employees working in retail. Most likely they're going to be reporting into Josephine. That's 58% of the total staff. So that is a big portion of the business that would fall under Josephine's area. Maybe she could use some help there. The production area, 242 employees there, 19% of the total staff. And you can see the finance area there. Maria Weber is the finance director, overseeing not just finance, but the IT manager's activities and the HR manager's activities too. And you are based under Paul Meyer. As we said before, you're likely to have plenty of interaction with Paul on the day of the exam. Looking at the products of the company, we can see that the product range is split into 3 segments: self-purchase, gifts, and the exclusive range. So self-purchase includes small packaged chocolates and chocolate blocks. The gifts includes box chocolates, seasonal gifts, collection sets and hampers, while the exclusive range is for the chocolate connoisseur, very specialized chocolates. Later, when we look at the budgeted revenues for 2019, we'll see that 26% of the revenues are expected to come from self-purchase, 56% of the revenues are expected to come from gifts, while 21% of the revenues are expected to come from the exclusive range. As we move down, we'll see that the products are produced in 3 types of chocolate: dark chocolate, white chocolate, and milk chocolate. Dark chocolate and milk chocolate both contain cocoa liquor, and the difference is that with the milk chocolate you're adding milk powder, and white chocolate does not contain cocoa liquor. Instead, it contains milk powder, cocoa butter, and sugar. The chocolate that the company makes also carry a variety of fillings and flavorings. The different fillings come in the form of caramel, cherry, mint, and praline. Flavorings include orange and caramel. So the trend in the industry is that consumers are looking for new flavors and fillings, up to 3 or more flavors in a single bar of chocolate. So people are becoming a little bit more experimental with the chocolates that they try. And there's a move, as we said before, towards more premium forms of chocolate. So you would say Chocolate Box, as a premium producer, seems to be well placed and is paying attention to the flavors and fillings that are included in their chocolate bars. So we've just seen the product type that the company is making as it relates to the 4 P's of marketing. The products of the company are high quality. As I said before, with high quality products comes higher costs of production. That leads me to ask whether the company could move their pricing a little bit higher. They have excessively priced products. That is likely to depress their profit margins slightly, given the fact that this is a company fixated on profitable business development. They may want to consider their prices and to price the products more highly. The key ingredient is cocoa, and with high quality chocolate, the idea is that higher cocoa content replaces sugar. There has been a move, as I said before, to more premium chocolate products in the industry. For example, Nestle, one of the giants in the industry, has reduced the sugar in their chocolate products by 32% between 2000 and 2013. What we see is that Chocolate Box, with their dark chocolate, has a minimum of 70% cocoa. With the milk chocolate, it's a minimum of 40% cocoa. With caramel or white chocolate, it's 35% or more of cocoa. And Belgium, one of the most famous producers of chocolate, they mandate in law that high quality chocolates have to have a minimum of 35% pure cocoa, and they ban the use of artificial fats to achieve higher quality chocolates. So you can see that Chocolate Box exceeds that high standard set in Belgium, for example. And given the fact that there is more cocoa in the chocolate means that there is less sugar going into the chocolate. And we'll talk about the general negative perception of sugar, and the threat of things like sugar taxes from governments is becoming more and more a talking point nowadays. So the fact that the company only has 3 products, but with some variety due to cocoa percentages and different flavours and fillings, that does increase slightly the variety of production setups and the variety of goods being produced. That will increase the cost and complexity of the manufacturing operations. Just a note on white chocolate. There is traditionally, white chocolate has been a little bit of a laggard. It's lagged behind dark chocolate and milk chocolate in the eyes of chocolate connoisseurs, but that's starting to change slowly. White chocolate is slowly but steadily transitioning from being perceived as a cheaper candy to a finer food in line with high quality dark chocolates. In the next section, then, we see the company's strategy. It is driven by the founders Adam Thurow, the non-executive chairman, and Sebastian Becker, the managing director. They're very focused on the brand image. They are keen to get across this image of expertise, luxury, innovation, and crucially ethical trading. And they see the brand image as being at the heart of future development opportunities for the business. So brand power is a differentiator in an increasingly competitive industry. And we'll talk about the industry trends, the fact that growth is set to slow soon, so the companies that can stand out in terms of the brand will continue to do well. I think it's interesting that they talk about the company's strategy being driven by the 2 founders. The non-executive chairman, Adam Thurow, really, you would say that his role as a non-executive chairman is to oversee the activities of the executive team, but not to get too involved in the strategy or the day-to-day operations of the business. And if he is involved, you would say that that runs counter to good corporate governance practices. So that's something I would flag up as a small area of concern. I think it's very likely on the day of the exam, you'll be asked to explore growth opportunities, whether they reside in new product formulations or new markets. I myself think that there is plenty of ground to be gained in their home market of Estland, given the fact that they have just 2.2% of the market. So I think they can focus on their current market. I think what they will have to continue to do is to develop new products with new flavors, new fillings, etc. The company, we're told, has invested very heavily in manufacturing equipment, and it is putting a big focus on research and development, which leads me to believe they're fixated on new product formulations, which I think is the right strategy. They want to open new stores in the future and to continue to look for profitable online opportunities and partnerships. So there could be a possible question about joint ventures. If they were to consider going into new markets, maybe they would do so with a company that's already established in a new market. They might want to look into new tie-ups with existing online retailers. And in the budget section later on, we'll see that they want to increase the number of stores to the end of 2019 to 120 from their current number of 108 stores. So the fact that they're investing as well in new manufacturing equipment, and we'll see that when we look at the financial statements, given the fact that they've purchased 11 million of tangible assets in the last year. They've also increased their intangible assets by 1.156 million in 2018. So it's likely that they would have high associated depreciation expenses, which comes from F1 IAS 16 property, plant and equipment. We would expect to see that in the financial statements. We'll look at that a little bit later on.